All right, guys, let's take a look here at the S&P 500. So what we're looking at here is 10, 20, and 30-year data on the S&P 500. Wherever data we're looking at, if you trade SPY, that's fine. Trade SPX, that's fine. Talking virtually the same instrument. Now, over the past 2 decades or 20 years, the first couple of months of the year have been a little bit of a volatile period for the equity market. And we can see that in current pricing. If we look at, we just pull up SPY here inside of the dashboard, you can see we've had some volatility here. We've had retracement to the downside, a big move up. We almost had a little mini flash crash there on the Sunday, Monday of the last week. And now we're back up to new highs. And a lot of this is, the economic momentum slowing down. Investors are digesting strength that is notorious of the equity market through the last quarter of the year. And if we talk about the VIX, the VIX actually has increased by over 25% on average between the start of January and the middle of March, as stocks do historically trade lower. And so this is the data we're watching. Here we are in price. We are going to be watching very carefully for what we call price and time aligning, looking for potential wouldn't say correction, maybe more of a retracement is a better term, to the downside. And this weakness in the equity market is then typically met with buying demand that we see here in March. We see this time and time again. We have retirement savings plan money putting to work, and that typically leads to a run up in prices that then peak here in the May or in June time period. So performance of the summer usually is pretty range bound, and the weakness during this time frame then presents a logical setup to start loading the boat up on equity exposure that is common through the last quarter of the year. So this is what we're looking at here: a potential retracement in the equity markets, or an uptick or spike in the VIX. Notice the monthly average performance here on the weaker side, followed by strength, followed by weakness. And if we look at the volatility here, February, March are on the upper ends of the range comparatively, with October leading the pack on the volatility front. So just something to be aware of and be cautious of around your positioning. If you're interested in how we use government data to also fine tune and tack on high probability confluence to our trades, I'm going to be hosting a free workshop here this week. I'll hyperlink you to the page, and I'll see you on the inside.